The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
With so many people living longer, the fear of outliving your money becomes a reality for many of us. Will I be a financial burden? Will I outlive my money? How will I be remembered? My name is Neil Himmelstein, president of Main Street Planning Group. Please contact me by visiting mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. I will introduce you to strategies that will guarantee you will not outlive your money, that can guarantee you will not be a burden on your loved ones. Through a collaborative approach, we will uncover solutions that offer tax-efficient strategies, lifetime income, and legacy planning, choice, organization, direction, and education. That is the code we stand behind. Contact mainstreetplanninggroup.com. That's mainstreetplanninggroup.com, or call 631-647-4694. And listen to me every Friday at 3 p.m. as I host the Main Street Code for Financial Success, right here on 103.9 LI News Radio. Good afternoon. Welcome to the Main Street Code for Financial Success. I'm your host, Neil Himmelstein. I'm here every Friday at 3 o'clock. If you miss me, you can catch me on Apple or Spotify, or go to my website, themainstreetcode.com, and there you can find our past episodes. We help hundreds of advisors across the United States, whether they be attorneys, accountants, or other insurance and financial advisors with your insurance needs, whether it be life insurance, long-term care, annuities, or disability insurance. And one of the things that we recommend to everybody is that you have a financial check, and that sometimes you want to combine policies and make sure they're all coordinated and doing the right thing. Not only do we coordinate your financial advisors, but we want to make sure your insurance portfolio is working the way you want it to work. And things change and things happen over time. I'm looking at a lot of policies now. I just took over another agency, and I'm seeing that people bought policies in 1985 and they're still paying for them and everything else. But I'm sure since 1985, needs have changed. Health has changed. Things are different. We have kids. We have wives. We go through divorces. We go through lots of stuff in our change. So you always want to review your situation. So I think it's very important. Today, I really want to focus on the foundation of financial planning, the true foundation of setting yourself up. And I compare it to building a house. When you build a house, the first thing you do is you lay down a foundation. That foundation, and then you need lots of screws and bolts and rebar to put the foundation together. I call that's life insurance. You need that. You need that as your base structure. It's your basic. You have to have some insurance. Then as you're building the walls, the nuts, the bolts, the screws, and the support, you need to have something to protect your income, disability insurance. Very important that you have your bases covered before you can even raise that house. You have to have that protection. Now, if you're borrowing money to buy a house, or let's say you're just going through college or whatever, or you're going through an apprenticeship program, there's a cost to that. It costs money to go to college. It costs money. So you're building your foundation, and you have exposure because you have liabilities. If there's people you care about, that exposure has to be protected. And how do you protect it? You protect it with life insurance and disability. You protect that exposure or that loss of income with some protection. And that's what we're talking about today. So you go and you buy a house, or you're building a house. Let's say you're building that house and you have this exposure. You have to protect it. Now I'm buying a house, and maybe I'm taking out a mortgage. If I'm fortunate enough to be given a house, that's great. But I'm taking out a mortgage for the house. That's a loan. That's a liability. Can my loved ones continue to build this house if that liability isn't protected? And the easy way and the least expensive way is to do it with life insurance. So people buy term life insurance to do this. Term, the very basis, you want to cover your basis. You want to cover your liabilities. And then you want to have something, especially as you grow and you build a family, you need that layer of protection. Now you're building that house, and maybe you're building a family, and you might need more protection. Okay? It's very inexpensive, very easy to do. You know, a lot of people, they'll go to work for a company and they'll offer group term life insurance, group insurance. And they think it's not costing them anything, but it comes out of your paycheck. And believe it or not, it's kind of expensive. It's 1 year term, and they base that pricing on a whole pool of people, sick, well, old, young. So that price seems very cheap, but there's a problem with it. And I'll tell you the biggest problem is, if you're relying just on that group insurance from a job or a company, and you leave that company, you don't have that insurance anymore. Or worse yet, what happened this week is an insurance company had such losses, they decided to raise that pricing. They doubled the pricing on that insurance. That can happen at any time in a group insurance. Now here's the big problem. You buy a lot of group insurance, you have a wife, you have kids or whatever, and you're building this family, and you're depending on this group insurance, and some years pass, or even if you're building your home. You know, when you're building your home, you have repairs. You have to take care of your home, and they're expensive. Okay, even your own personal health. If you have health, and everything's great, and you're young, and it's healthy, and I know a kid, 19 years old, he got out of high school, he was kind of on his own, he didn't have a health insurance, and he was skateboarding, he broke his leg. Well, how much did that broken leg cost him? It cost him huge amounts because he didn't have insurance coverage. Very basic, you need to cover your bases. Okay? Now, as your family grows, as the people that rely on you grow around you, the people that you love and care about, and they rely on let's say your income, you need to protect it with more life insurance. So term insurance, very inexpensive, very easy to get when you're young and healthy. So let's say I buy a 10-year term. Now, I was listening on the TV this morning. I think it was Select a Quote or one of these. Okay, John got insured for $20 a month for $500,000. They didn't tell you how old John was. John was probably 30. And it's probably 10 years of coverage. Well, here's the situation. John at 30, he buys this $500,000. And that's a great thing. He's protecting his family. That's wonderful. I'm trying to find something I can afford. Okay, so he can afford that. Okay, that's good. Well, here we are, year 8. Okay, he's now not 30, now he's 38, and he has 2 young children. And John all of a sudden got COVID, and now the COVID has led to a heart situation. And all of a sudden, in 2 years, his insurance is running out, so he wants to replace that insurance. Well, he can't do it now, okay, because now he's got a heart situation, and now from $20 a month to replace that insurance, maybe now it's $200 a month. Maybe he can't afford that because he didn't do the proper planning. And that problem with buying that 10 years of insurance is, even if you buy term insurance for 10 years, you better make sure it's convertible to something that's permanent. What do I mean by that? The ultimate goal of term insurance, I like to call term insurance as the gateway drug of permanent insurance, of life insurance. It's the gateway insurance product that you need, but ultimately you want insurance for your whole life. It doesn't end in 10 years. Listen, in 10 years, in 20 years, I may have a big need. My kids are growing up. They want to go to college. I want to buy maybe 20-year term. I want to buy as much as I can so that they can, they're living off of my income. They got big expenses for college. After college, their expenses don't necessarily go away. There might be college debt. Not only are there college debt, what a horrible thing to do is start a career when you're in debt. And that's a problem. Because now, let's say you have a child that wants to be an entrepreneur and wants to do their own company. Well, how are they going to afford insurance and everything else and start that company if they're in debt? How do they start that way if you're in debt? So the only way to prevent that, and you can't necessarily help them if you're not living, or if you're disabled, when you got to help yourself and you got to save for your own retirement, is you got to protect yourself with some sort of insurance. Okay? So life insurance is vital. Disability insurance protects your paycheck. So if I can't work because I got sick or became disabled, if I can't work, I can still get a paycheck if I buy that insurance. And people don't buy disability. Oh, I got it at work. Yeah, the problem with disability at work is if you leave work, you no longer have it. And how much of that is at work? So what I tell you is if you have a job and they give you all these benefits, bring home your benefit package and review it with us, because it's not enough. It's good that you have it, but it's not enough. You need to create your own benefit package that works for you. And if you need additional coverage, we can integrate it with what you have at work, but the idea is the basics of financial planning is you have to prepare yourself. You're listening to the Main Street Code for Financial Success. My name's Neil Himmelstein. If you want to reach out to me and you have any questions about your situation, give me a call, 631-647-4694, or visit me at themainstreetcode.com. Please, I encourage all your questions and comments. And again, if you have a job and you have a benefit book, bring it home and review it with a professional like myself. Thank you. We're going to be back after the commercial. Welcome back to the Main Street Code for Financial Success. Hope you had a nice break there. Before the break, we were talking about building your foundation, building your house. And the house is that foundation and how important it is. The bolts, the nuts, the screws, and all that is your protection, is your life insurance. I know when I built my house, they had to build hurricane straps here in Long Island. Never heard of hurricane straps. Why? In case there's a hurricane. But that's what that's why you need to buy disability insurance and life insurance to protect yourself. Now, before the break, the other thing I was talking about was looking at your benefit book from your job and seeing what benefits you have and integrating that whole plan with what you have. And that's so important that people do this and everything gets integrated. Here's the other thing that happens. Over the course of time, life changes. It changes dramatically. Just look at the last 5 years of COVID. Look at the wars going on. Look at the inflation. It's going up and down like a yo-yo. The stock market's booming. All these things happen. They don't happen in a vacuum. They happen every single day. Things change. The problem with most people that buy life insurance and other things is they'll buy it, they'll put it in a drawer, and they forget about it. Well, you may have had the best intentions, had the best salesman in the world, had the best everything, and you put that in that drawer, and 5 years later, everything's different. Maybe you need more insurance. Maybe you need less insurance. Maybe it's not the right kind of insurance. Maybe you had a child in the meantime. Maybe, all kinds of things happen. Maybe your health changes. That's a big deal. Listen, our health doesn't get progressively better as we age. It progressively gets worse. Unfortunately, I don't want to be Debbie Downer, but unfortunately, we're machines. And machines do break down over time. If you're one of the lucky ones and you never break down, and that's fantastic. Very few. At some point, certain elements, whether it's your body. Listen, I can't go out and wrestle anymore. I can't go out and play, full court basketball like I could when I was a kid. I'd love to. Mentally, I can. Physically, I can't. It's just a matter of fact. It's a matter of time. You age. So your insurance policies change also. One of the biggest changes you'll see is, I look at policies all the time, and what I like to do is when I sit with you, I look at all your policies and look at everything. You may have be a great planner and everything else. Maybe you have policies that aren't performing. Okay, a lot of insurance policies are bought, especially permanent ones, on interest rate. Is it bought on a fixed interest rate when interest rates were paying 2% or 3%? Was it bought on a fixed interest rate when interest rates were 10 and 11%, and now your insurance policy was only paying 3 or 4%? We see this every single day. I looked at a policy this morning and had a loan on it. And he did a great job. He put a lot of money into this policy, but he had a $70,000 loan on it. and I looked at the internal rate that the insurance company was charging, because it's an older policy, it was charging 7.4%. Well, just like your mortgage and everything else, I have insurance policies which have loans on it at 2%. So even if they're not paying back the loan, at least I can lessen the burden of that policy at a 2% rate rather than compounding the 7.4% rate. And that's a big deal. See, insurance policies have a lot of internal workings that we like to look at. So one of the great things about insurance is you can take a big loan out on your insurance policy. There's never a 1099, and nobody looks at it, and nobody's calling you up and saying, hey, you got to pay this back. But if you let that policy lapse, why will it lapse? Well, maybe I'm not paying back the loan, and the loan gets bigger and bigger and bigger, and all of a sudden there's not enough cash in the policy to support the policy, so that policy lapses. There's two things that happen. One, you have no more insurance, and two, the other thing that could happen is you could have taxes on all that unearned gain. People don't realize that, and that's ordinary income tax. They could get, they give up their policy, and all of a sudden they get a big tax bill. Not good. So this policy I was looking at this morning on this gentleman in Pennsylvania, he had a $100,000 death benefit, but he has a $70,000 loan. What happens if he dies with that loan? Well, very clearly, the loan gets paid back, and his beneficiaries get $30,000. That may be fine by him, okay? But that loan keeps increasing every year. So if he doesn't pay into that policy, there's two things that happen. One, the interest rate on the loan compounds, and that could change every year. And every contract has different loan rates. And two, he does have a cash value policy, and there's a crediting rate, and that could be crediting at a certain thing. And whether he puts money into it just to pay his insurance or he's paying no money, that loan will grow, and maybe the death benefit will be, maybe next year I'll have an $80,000 loan and the death benefit's $100,000 and only $20,000 behind because he didn't put any money into it. So we look at these all the time, every day, and we look at what's the growth, how is it growing, and how's the loan. Now, if you have bought an insurance policy, a permanent policy, I don't care if it's a universal life, a whole life, a variable life, an index life, and you're not watching it on a year-by-year basis, or you're taking loans out, which is perfectly acceptable, and you don't attend to this for a couple years, well, things can happen on this policy that are dreadful. The crediting rate could be horrible. The loan rate could be stupidly high. And we can solve that by putting it into a policy with a much lower loan rate and a much higher growth rate. So that maybe if you just switched it, not even put money in, maybe you'd leave behind $150,000 instead of 20 or 30. And we recently did this with some policies without even putting money into them and saved the client millions of dollars, just by restructuring it the correct way. Also, I have to say this about a lot of old life insurance policies. They don't have riders like long-term care insurance, long-term care riders. You know, the initial thought of people is, well, long-term care insurance is expensive. Well, now with these hybrid policies, you could be paying the same thing that you were paying for your permanent life policy, but have the added benefit and the added comfort of knowing if I have a long-term care event, which over 70% of us will in the future, that I have a pocket of money to pay for that so that I don't have to go through all my assets and not have anything left behind or any life insurance for that matter. So it's a big deal. So I encourage you to review your old policies and look at what you're paying and give us a call and let us review everything and let's consolidate it and structure it so not that you're paying more money, you're paying less money and you'll leave more behind. That's the goal. Pay less, leave more behind, right? You know, there's two ways of making money. One is make more money. Two is reduce your expenses. So by reviewing your policies, we can hopefully make you more money and reduce your expenses. Isn't that a factor? Now, a lot of people on fixed income or at retirement are in a situation where everything's status quo. The Social Security is paying their bills. Maybe they have a pension, and everything's rolling along fine. But they don't account for the inflationary environment we're in. So they may be sitting on a safe investment at 2 and 3% where they could be getting 5%. Well, that's going to help you deal with inflation down the road. So don't be myopic and think everything's great today and it's not going to be tomorrow if you don't plan. So I don't care if you're 20, 30, 40, 60, 80. We have clients of all ages, and they all need planning. Nobody is set. We can always do better. We can always protect better. We can always rearrange and structure it better. And what I always recommend is bring in your whole picture, all your insurance policies. Let's look at them all in one swoop and see if we can't do better for you, and see if we can't improve your lifestyle, improve your family's lifestyle. Make sure you're not a burden to your spouse and your beneficiaries, and make sure you can protect and increase your legacy to your family or your church. We want to make you better. Anyhow, you're listening to the Main Street Code for Financial Success. We are running out of time. If you need to reach out to me, 631-647-4694. That's 631-647-4694. My name is Neil Himmelstein, and I hope you enjoyed our show. Thank you.
The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.